Okay, this is Brent from tradeguild.blogspot.com, and this is market review for the 17th of July 2007. Big news today. The Dow broke through 14,000. You can see a loss of momentum over here in these smaller candles. These spinning top right over here. Anyway, we broke through 14,000, and everybody's pretty excited about that, I guess, on CNBC and whatnot. Basically, we had more mergers going on. Mergers have been hot lately, really paying up on the premiums for steel companies and other companies, 20% premiums and whatnot. So a lot of activity in mergers. The bulk of earnings thus far have been pretty positive, so the market likes that. And today we got the first drop in producer prices since January, so all that helped to send the Dow up through 14,000. And we'll look at one stock in particular that was responsible for that move today. We're going to take a look at the market broadly speaking. I'm going to use the spiders as a proxy for the market. This is ETF for the S&P 500. I use it just because I can chart intraday indicators with it, and the index itself, I have some trouble doing that. First, we're going to take a look at 3C in an intraday time frame. This is a 15-minute time frame. Basically, 3C is my private accumulation distribution indicator, and basically it should make new highs with the market making new highs. If it doesn't, you got a sign of distribution, and vice versa. So anyway, if you can see this, I know it's a little difficult to see right now. I'm going to bring out a little magic marker, and we're going to look at a couple things. Some price divergences. Positive divergence here as price is slightly higher, but look at how much higher this indicator is over here. Negative divergence over here. You can see price is just about the same, and we have a negative divergence. There's the sell-off from that. This is 15-minute time frame. Positive divergence over here, so we see the rally building off that, and here's a negative divergence at this top, sell-off, and over here we're pretty much in gear. What I want to show you here, if we can zoom in a little bit, is what it looks like now. You can see it's actually in a leading divergence to the downside. A very, very bad leading divergence as well. If you take a look at what the rest of the chart looks like, this is really, really out of proportion, out of whack with the rest of the readings that we've seen over the past few months. I want to show you one thing. I've pointed this out on a previous video. This is my my block setup, one of my block setup I use for institutional positions and whatnot in the market. And one thing I really like is this institutional index, where you can see where funds are flowing into the different indexes, the S&P, the Dow, and the Nasdaq. And as of last week, let's see, I don't have them labeled. I know it's kind of hard to see right now. I think this is the S&P right here. You can see we had a little bump over here last week. Basically it went up a half of a percentage point. And over here, again, the Dow last week, again, it went up another half of a percentage point. And then we have the Nasdaq Composite, which went up 2 percentage points. So basically going into this week, institutional investors have put more or less, as far as the gain goes, 4 times more investment into tech rather than the S&P 500 and the Dow. So that was kind of an interesting thing that we saw last week, and I pointed that out. And that's kind of come to fruition this week, and I'll show you what I mean by that. Let's take a look real quick at the stocks. Just pull them up here. And the stocks are a semiconductor index. Let me get rid of this. And look at the gain we've seen this month in stocks. Now keep in mind what the investment looked like in Nasdaq. It was 4 times more than the S&P or the Dow, or if you put the S&P and Dow together. it was twice as much as both of them combined. So we see the stocks just off to the races. Apparently institutional investors knew something maybe that the rest of us didn't know, at least not to that degree. And let's take a look at a few other things here. We want to take a quick look at market breadth, some of the breadth readings, and I'm going to use the Warden T2 series. If you have telechart, these are really, really cool to use. The first one is T2118, and this is the McClellan Summation Index. I always have a hard time saying that one. Glad I made it through. So basically this index is in white. I have the New York Stock Exchange in blue, and readings below zero, where this red line is, generally are taken as a sell, and crossing above zero is taken as a buy. You can also use a 10 and 20-day moving average and use crossovers for buy and sell signals there. But if you look in the past here, you can see, for instance, we have a buy signal here and the market rallies up. We have a sell signal here, a little dip down, buy signal here, it rallies up, so on and so forth. There's a sell signal, a little dip down. Right now, we're pretty much the closest that we've been to zero all year. It's rallied up a little bit, but this is very close to producing a sell signal. Let's take a look at a couple others here. The next one is let's see, what is it? T2125, and this is the Nasdaq advanced decline line. Let me just change our comparison chart here to the Nasdaq. This is the Nasdaq, the entire composite index, and the Nasdaq is in blue, the Nasdaq advanced decline line is in white. And I mean, look at what's going on with this. I mean, we're making new highs over here, and this index, this advanced decline line, is just trending down. So we're not seeing the breadth that we would want to see associated with this advance. So it's ringing hollow. We're going to look at a couple other things. I'm going to really drive this point home to you. Let's pull up T2108, and this is percentage of stocks in the New York Stock Exchange trading above their 40-day price moving average. Okay, so again, we're going to use the New York Stock Exchange, and the indicator is in white. This is the percentage of stocks trading above their 40-day moving average. You would think with the market making new highs, we would have more stocks trading above their 40-day moving average. That is just not the case. As a matter of fact, it's been trending down badly since April. We're making new highs over here. Look at this. I mean, it's just really, really, really thin market, in my opinion, and in the opinion of this indicator. Let's take a look at another one. Let's really sink our teeth into this while we're here. T2110, if you're following along with telechart. This is percentage of stocks trading one standard deviation above their 40-day moving average. Back in April, we were at 60%. Stocks trading one standard deviation above the 40-day price moving average. Now we're at 40%, 35%, as we're making new highs on this move. Not good. And finally, one more in this T2 series, and I'm going to have to end this video. Let's take a look at T2115. And this is percentage of stocks trading two channels below their 200-day moving average. So these are stocks that are two channels below their 200-day moving average. And look at the increase from 2% back in May to 15% now, as this market is making new highs. That's really scary. I'm going to be back with another video. We're going to look at some of the stocks that have moved today, that have moved the market. We're going to take a look at a pretty cool idea that I've jumped into. I'll see you in just a minute.